Well, welcome everybody. Now, few areas of finance capture the balance between purpose and performance as strongly as impact investing. Now, data from our own PRI reporting database shows that 88% of our signatories now incorporate sustainability across more than half their assets, a clear sign of how mainstream this has become. The critical question that we want to answer today is how do we achieve a double bottom line, delivering both financial returns and a positive social and environmental impact? Now, this is no longer a niche concept or conversation. Impact investing has moved into the mainstream, so we're delighted to have such an esteemed group here today to discuss this topic. Over the next 16 or so minutes, we'll explore the macro trends shaping impact investing, the tension between short returns and long-term outcomes, and the practical steps to overcome barriers in undeserved markets. So let's begin by looking at the bigger picture. Jerome and Alaa, just first of all to you, what macro trends are driving the growth of impact investing today, and how do you see this evolving over the next 5 to 10 years? So Jerome, start with you.
Thank you. It's a pleasure to be back here this year. For those who don't know who Capricorn is, in a few seconds, we are a $15 billion climate tech / deep tech investor. We've been in business for about 25 years, so we've seen the growth, the success, and the more difficult times. Office are in Palo Alto and New York City. We're very proud to say that we are a certified B Corporation and one of the few asset management companies of our size to already have reached net zero by offsetting scope 1, 2, and 3 of our emissions. The business is a lot venture into deep tech, a lot into GP staking, where we support other asset management companies, and traditional asset management trying to identify the trends in impact investing. And going back 25 years in relationship to today, not much has changed. In 2000, we were focusing on water, ag, energy. Now, energy meant something different. It was more how to promote renewables. And to that degree, it's been a success because solar now is the cheapest form of energy. What has changed over the past 25 years is that while we started with public market, we really evolved into private market. And the trends remain today. In terms of your question, where do we go? We go a lot in space. We see a lot of future in space in relationship to energy. Obviously, power, different forms, geothermal, fusion, and other things. And obviously, health, for the obvious reason.
Thank you. What trends are you seeing?
So by a bit of background, 500 Global is historically a US-based VC, and over this past couple of years, we've really leaned into working with sovereigns and governments, philanthropies and other partners to look at how we create blended finance vehicles. And I think one of the biggest trends I'm seeing is that governments and funders are really interested in tools like concessional financing or first loss to attract private markets into more long-term sustainable investment approaches. I'd say the second thing is changing demographics mean we are seeing a lot more interest in health and recognizing that that's not a social good, but it's actually a core economic driver. I think people are recognizing that climate risk is actually a huge capital risk and investing with that in mind. And I think we are seeing younger generation investors, philanthropists, funders really look at investment as a necessary double bottom line. They're creating mission alignment as really part of the strategy, and they want to see both market return and social return in the way that they spend their resources. So I would say those are likely sustained trends in the coming 5 to 10 years as well.
Great. So perfect introduction to give us a bit of context. So how are institutional investors balancing the pressure for short-term returns with long-term nature of impact outcomes? And as context, PRI members are finding that these goals are increasingly aligned. 71% of asset owners report that sustainability integration improves long-term risk-adjusted returns, and over 60% say it has delivered tangible value creation benefits in their portfolios. So Eugene, over to you. How would you see this balancing act that investors are trying to make here?
Thank you so much, David. As a large global asset manager, we actually see the entire spectrum, of the ambition when it comes to sustainability among our client base. And I think given that also there is now, luckily, we have a wide range of different investment strategies that would allow to deliver on both the impact outcomes and the financial returns, it's really choosing the right strategy for the right impact ambition. And I'll give you a couple of examples. For example, like we have impact strategies on the real estate side, and these are really strategies focused on value appreciation. So we don't really have to feel so much pressure for short-term returns. And our investors know that because it's appreciation-based strategy. Equally, we have an impact strategy which we run for our parent company, Prudential Financial, and that is very much focused on income generation. And that's why sort of it's a different type of investment. The good news is that these days, unlike what it was 20, 25 years ago, you can select, you can have impact-focused investments in public and private markets in different asset classes and across different levels of ambition, investment time horizons, and return spectrum. So it's pretty good time right now.
Excellent, excellent. So let's just keep going and delve a little bit deeper. So what are the biggest barriers to channeling impact capital into undeserved communities, and how can they be overcome? So Elia, over to you. Your thoughts on this question?
Back to me?
Oh, Jerome
Yeah.
first, yes, sorry.
Oh, it's quite all right. I think I've been here now 2 weeks, and I've attended many of the conferences last week and this week. I was a bit distressed coming into yesterday because, the words climate change or global warming or decarbonization, while they were very centered to the conversation 2 years ago, they really give room to AI. AI was the topic of most of the panels and most of the conferences. And when asked where does impact come into play, I think it's a fairly obvious thing that there are two levels where money is going to go. One is clean power, because it's a requirement for AI and data centers. And the other one that we are very involved with is space. And I encourage people to think about obviously AI and data centers, and the announcement that we made last week regarding SpaceX and potentially sending all this infrastructure into space, I think will alleviate a lot of the energy pressure that we are facing.
So can I pick up this question around, though, the biggest barriers to channeling impact capital in undeserved communities? And how do we think that they can be overcome? So Alaba, back to you.
I think I'll answer that in two ways. One is I think we actually are responsible for reframing our understanding of underserved communities. Oftentimes when we talk about the vast majority of the world, we call it the global south. I think as investors, as leaders in this space, we need to be thinking about it as the global majority. 80% of your population lives there.
Yeah.
Your spending capital is there. Your future growth markets are there.
Yeah.
When it comes from everything to real estate, to AI, to climate, et cetera, those are the communities in which we're going to see the greatest use of innovation and adoption of innovation, and recognizing that those are genuinely important financial markets, and that the only way they reach that pivotal point is through core investment today, I think is very critical. So there's an education for ourselves that's important. I'd say the second piece that's equally important is how we leverage capital. We are increasingly seeing investors and governments and philanthropists that are much more open to leveraging catalytic capital. So instead of my dollar being just a dollar, how do I think about a financing facility or a fund with really three tranches, right? You have your LPs or your funders who are less interested potentially in the financial return, but really want some level of impact or social resilience return. In your kind of catalytic tranche, they might provide first loss or concessional capital. In your second, you might have those that want some financial return, but also some impact return. So you're thinking your development finance institutions, your multilateral development banks. And at the top, you'll have your private sector partners who are really thinking about that long-term financial return. And I think if you're able to really bring that together to say, actually, investing in climate is economically smart and it's socially smart, and we have different risk appetites in this facility, I think are able to attract a lot of different partners into financing vehicles that speak to their level of risk, their level of interest, and their prioritization of impact.
And David, maybe I give example of that, because we had that, we invested in Seychelles Blue Bond, And this is where the World Bank came out as a guarantor of our loan. And that really helped to de-risk that particular investment because we were able to substitute the credit rating of the World Bank for the credit rating of the government of Seychelles. And that's exactly what you were talking about, this type of...
This is such an important point to understand the different risk appetites and that investors slot in at different points. But over to you, Dr. Shamsheer. Your thoughts on the biggest barriers for underserved communities?
I think the risk perception is a big deal because people who want to go for a sustainable sort of funding, there's always an element of uncertainty, fragmentation. There's no model at scale which is available. We talk about double bottom lines. I've been in Abu Dhabi for almost 25 years of my life. From day one, they always say healthcare has to be double bottom line. We cannot only look at profits, but if you see the various activities that we do around the year, it is all about doing good for the humanity, doing at scale. We operate healthcare facilities across Africa. The difficult parts we operate out of Yemen. So again, that is a intrinsic principle of collaborating with large entities, especially the private government collaborations. There's difficulty in ensuring the exits. So there's no capital market. Skill gap is a huge thing. So I think it's time for events like these to formulate white papers of how we can develop a model that could be sustainable, impactful, yet bankable. So I think that's the question raised, is that the honeymoon is over. We just need to be more and more tactical. We talk about AI, but there is an element of cost in implementing AI. Yeah. And many of the places lack infrastructure, connectivity. So I think this is a wholesome time now to sit across the table and find out meaningful solutions.
And I think,
yes,
I mean, that's an excellent example of where some of that financing can come in, really the enabling infrastructure where people can't see the immediate economic returns, but you recognize that that's necessary to be able to create the private market ecosystem that can actually cultivate that in the long term. The second thing I'll say, which I think is super important that you mentioned, is we are, for the first time in a long time, especially because of the contracting of aid, because of, I think, the different risk that we're seeing even in established markets, we're seeing new people come to the table. And I think taking full advantage of that and saying very practically, okay, what could, for example, faith-aligned financing really be able to provide in this country? What would the World Bank be able to offset? Could we do resource-backed guarantees? What does that tactically look like? I think we're starting to have those conversations very tangibly for the first time.
So let's keep going with this theme. How can impact investors ensure accountability and transparency in emerging markets? If we're wanting to get more funding coming into emerging markets. So how do we get the transparency and accountability while still enabling innovation and long-term value creation?
So I think we need to introduce a lot more governance and transparency around these markets because the uncertainties are so high and even the corruption factor in some of these markets are also very difficult to penetrate.
Yeah.
And I think there is a lot of underlying factions that don't want these changes to happen, yet people travel out. You see the gap is widening. And I think it's time that we digitize things. It's not just about the reports, it's about demonstrating a proof of concept that can be scaled. So right now, what we are trying to do is bring down the cost by half. We are doing hospitals in containers, and we know connectivity is important, so we're bringing dashboards, we're putting up skilling centers. We have partnered with Abu Dhabi Ports to create a company called as Doctour, which is again into Africa. And what we want is build a model on scale. And I think seeing is more important than what you do as reports. Outcomes are important. And I think it's about the scale that we need to work on. I think that's very important.
Excellent. So we are just wrapping up here. I just wondered if the panel wanted to add anything more to this topic before I close up. Eugenia?
Can I just say that we talk here about really impact-focused investing, but it's so encouraging to see that now we have investors, traditional investors, mainstream one, pension funds, insurance companies, sovereign wealth funds, really thinking about what are the impacts of their investments. It's not pure form impact investing, but there are many different forms, from climate targets, decarbonization targets, to focusing on stewardship, to allocating proportion of their portfolios to use of proceeds, credible use of proceeds instruments, to tilting towards companies and assets that are supportive of sustainable development goals. We are seeing the entire spectrum, and that is really, really positive.
Yeah, no, I love that comment, because we've been calling it mission aligned financing. So there's those that are concretely impact investing, and then I think there's this increasingly large group that is mission aligned, that is thinking, yes, we're traditional investors, but how can we leverage our investments better? How can we do this in a way that is more sustainable, that is more reflective of our broader goals? And I think a lot of them are actually seeing it as a long-term risk mitigation strategy, which I think is really exciting.
I think the Abu Dhabi model is a gold standard when it comes to dealing with the indifferences around the world. And I think if you can have a combined Department of Health, which is a regulator here, which always tells us how to look beyond our own responsibilities, and especially with our leadership's ability to solve problems around the world. And I'm sure many of the international problems will be solved sitting in a venue like Abu Dhabi.
So just in summing up, just to validate, I mean, from a PRI perspective, as we sit with 5,000 signatories around the world, it's clear to us that investors are continuing to play a central role, even in fact actually stepping in, want to be more deliberative in their capital allocation for outcomes. And so they are looking to shape more resilient, inclusive and future-ready economies, because their interest is long-term value creation, and so they need healthy economies to do that. From our vantage point as the world's largest network of responsible investors, we see the shared standards, consistent reporting and collaborative engagements are what truly turns ambition into real-world outcomes. I think we've run out of time. You've been a fantastic panel. I hope it's been a great topic, and hopefully the audience has found that interesting. Thank you very much.
Thank you. Thank you so much.
Thank you.